So, question to ask: why do banks care how much money I have left over after closing? So, most people think I've got 10% down. So, with the SBA, I'm pretty good, right? Isn't that about what the SBA cares about? The answer is not quite. The SBA, yes, they want 10% down as a general rule. And we'll talk more about in other episodes about how you can do possibly less down than that. But generally, they're looking for a 10% equity injection just to enter the game. Yes, you usually need to have 10% down to qualify for an SBA loan. That's a safe bet. But the bank's looking for much more. They don't want to see that you can just scrape together a down payment. They want to know if you have what it actually takes to survive after closing. So, question to ask: why do banks care how much money I have left over after closing? If I've got the down payment, if the business cash flows, isn't that enough? The answer is really post-closing liquidity is one of the most important things that you can worry about or be aware of. Banks want to make sure that you've got some oxygen left over after closing, usually at least 3 to 6 months of personal expenses in the bank. If you cut it too close, you're just setting yourself up for a high risk potential of failure because the first year of owning a business is bumpy. And if you're out of cash for the first time your payroll is due, the whole deal starts to collapse or at least gets really tight. So the rule is keep a safety net. It's about proving you won't suffocate once the deal closes.